Hey everyone, Dave Keller here with Market Misbehavior. 2022 was a challenging year for many investors. Now that we begin the new year, 2023, what's next for the major averages? Today we're going to break down a chart of the S&P 500 and focus on two key levels you need to watch. So 2022 was a frustrating year for many investors. A lot of downtrends, a lot of stocks failing to hold support, a lot of bear market rallies that never really materialized above resistance levels. Now the S&P 500 is settling into a bit of a consolidation phase right around the 3,800 level. Today we're going to look at a chart of the S&P 500, focus on that range between 3,800 and 4,100. Why that range is so important, why that defines the consolidation phase we're in, and why a break of outside of that range in either direction really could indicate the next big move for the major indexes. Before we get to the chart, if you like this sort of thinking about investor decision making, behavioral biases, and technical analysis, I hope you'll subscribe to my channel. Also, if you like this video, give it a thumbs up. We'd very much appreciate that back. Finally, put a comment below. Which level do you think is most likely to be triggered first, below 3,800 or above 4,100, and why? Let me know in the comments below after you watch the video. Now, looking at the chart here, you can see the overall transition from the bull market phase in 2021 to the bear market phase in 2022. You can see what defined the year 2021. Consistent new highs, higher lows as the price went higher. The market overall just in a nice consistent uptrend. Very rare pullbacks, and pullbacks in general were in the 3 to 5% range at most. Talk about a phase we've not seen now in quite some time. 2022, you completely flipped that over. The uptrend turned into a downtrend. You went from higher highs to lower highs, higher lows to lower lows. Instead of pullbacks being brief, you had rallies, bear market rallies that really often failed to eclipse key levels of resistance. And when we did make it to a new swing high like we did in August, we failed at things like the 200-day moving average. Long story short, it was a frustrating year. But if you look what's happened in the last couple weeks here, we're recording this in early January of 2023. You can see how the low in October and then the peak in November, December, we've now come in and we're about halfway between the low around 3,500 and the high around 4,100. We're settling in right around 3,800. Now, why does that level sound familiar? We're going to look at my sort of normal daily chart of the S&P 500. I use this every morning. This is part of my morning coffee routine that I've talked about on my YouTube channel many, many times. The reason why 3,800 should ring a bell for you is because we've talked about it many, many times in our work. Because 3,800 represents a 38.2% retracement from the March 2020 low to the January 2022 high. So anytime you have a big bull market phase, like we did from 2020 to 22, and you start to pull back within that range, it's a really good idea to take Fibonacci retracements because it gives you a framework. It gives you a frame of reference to sort of more clearly define the trend, to anticipate levels at which you may find support or resistance. Now, I like to use Fibonacci retracements on a number of different time frames, but the key one is sort of that big picture structure. So March 2020 as the low, January 2022 as the high. If you take 38.2% of the way right back down, that lines up with the 38.2% level you see on the chart here, which is just above 3,800. It's technically around 3,815 to 3,820. That level also represents a 61.8% retracement from September 2020 to January 2022. So a number of different time frames sort of delineate that as a pretty key level. So we talked about that level a lot here in May of last year, which ended up being a pretty significant bounce into the peak in early June. We broke below that level briefly, but then rallied back above. We broke below it again in September and October, but as you can see, we continue to trade below it, but then rally right back above there. Now, in the last couple weeks, starting in mid-December through the end of December, you can see we bounced around that 3,800 level quite a number of times. Literally, the intraday low on a bunch of these days is almost exactly at 3,800. I don't think that's an accident. And if you ask me whether these levels are important, I think a chart like this shows how much in the market and how much traders and investors pay attention to these key levels, often around big round numbers or key levels that are talked about a lot with my peers in the industry. But you can also see on the upper end the fact that we've rallied up to 4,100. We first rallied up to 4,100 in late November. We then rotated up to that level again a couple weeks later in early December, and then we sold off to where we're at right now. If you look, that break up to 4,100 was when the S&P 500 first got above its 200-day moving average, and I don't mean first time ever, but the first time since spring of last year when we actually were able to close above the 200-day moving average. You can see that we did that for about a day or two and then quickly closed back below it. Again, here in early December, we actually traded above the 200-day but never closed above it and then rotated back down. So clearly the 200-day moving average, a clear level of resistance. That was also what happened back there in August. Here's where it gets even more interesting. Take a trend line, taking the January 2022 peak and the March 2022 peak. You can see that lines up almost perfectly with the August 2022 peak, also the highs in late November and early December. So while this game that we play as investors is never easy, I would say in some points it actually is pretty straightforward because we have a trend line now which clearly defines the downtrend that we've been experiencing over the last 12 months. We also have a key support level, 3,800, which is basically a level based on Fibonacci retracements, which we first reached in May of last year, but now once again becoming important. Just to finish off, I want to talk to you about the key levels to watch and why they're important. Three things that I'll highlight here. I talked about a trend line off of the highs, and I will say anytime you have a trend line that connects highs so clearly like you see on this chart, it's important. I was taught once is chance, twice is coincidence, three times is a pattern. And that was a saying to remind you that connecting a trend line using 2 points just gives you a line. That doesn't really necessarily represent the trend and how it's evolving. But if you confirm that with a third independent point, which we did in August, and then once again in November and December, all of a sudden this line is really a beautiful and consistent visual representation of the pace of this downtrend. So in a lot of ways, this analysis from here on out is pretty easy because at some point, I guarantee that price will go back above that trend line. I don't know if it's going to happen in the next couple days or the next couple weeks or the next couple years, but I'm fairly confident that at some point equities will continue a bull market phase and that upward trajectory will push the price above this trend line that has become so clear. What that means is, for the most part, you can sort of remain cautious and defensive until we break above that level of resistance. If you're more conservative, I think getting above 4,100, which would be the highs from early December, would be a nice confirmation. We break above the trend line, and then finally, when we break above that, the high from December, then the S&P would be making a new swing high. That could signal a bit of an all clear and suggest further upside from here for the major benchmarks. On the other side, the other level to watch is 3,800. That's where we've been sitting here for the last couple weeks. So if you think about what happened, we failed to get above the 200-day, failed to get above trendline resistance, and now pulled back to an established level of support. As long as this holds, this is more of a consolidation phase. This is more, things aren't getting horrible, they're just not getting better. But if we break below 3,800 and follow through to the downside, all of a sudden I think that should compel you to start to engage some downside price objectives for the S&P. What's the likelihood that we retest the lows from October around 3,500? What's the likelihood we go even further to 3,200 or even further? Before we get to a significant loss, all large losses start as small losses. So first things first, the line in the sand is 3,800. Can we hold that? If so, things aren't that bad. We follow through below 3,800. I think things could get pretty bad pretty quickly. Another way to think about this consolidation phase that we've been seeing is using the RSI. Look at when we made the swing high in August, and look at when we made the swing low in October, and look at what that did to the RSI. When we attempted to break through the 200-day here in August, the RSI became overbought. And overbought basically means the price has gone too high too quickly. More often than not, you'd expect at the very least a brief pullback to alleviate that overbought condition. When we sold off in late September into early October, we actually became oversold, and this ended up being a bullish momentum divergence. Lower lows September into October, higher lows September into October using the RSI. So when we rally, we become overbought. When we sell off, we become oversold. Now compare that to the peaks that we saw in late November and in late December. The RSI is sort of petered out around 60, never really made it much above 60. And when we sold off, the RSI never really made it much below 40. So instead of hitting these extremes of overbought and oversold, the RSI range is becoming compressed. So just like the S&P is making lower highs and higher lows for now, the RSI is actually compressing as well. This recognizes or represents sort of a lower volatility environment, a consolidation phase as the market hits a bit of an equilibrium around 3,800, which means we could be setting up for a break in one of those directions. Now, which way? I think that's still an open question, but the two levels I will watch is the S&P above this trend line and ideally above 4,100 for the bull case, below 3,800 for the bear case, which could engage a downside target to 3,500 or even 3,200 on the downside. So that's it, folks. That is a walk through the chart of the S&P 500. Some key levels to watch, focusing on 4,100 on the upside, 3,800 on the downside, how the trendline analysis and Fibonacci analysis helps us establish those levels, and why RSI can be a great way to visually understand the consolidation phase that we're in right now with the major equity indexes. Which do you think will break first, above 4,100 or below 3,800? Give me a comment below the video and let me know which one you think is most likely to happen first and why. For Market Misbehavior, I'm Dave Keller. Be well, be safe. Talk to you again soon.